7 Eastern, 4 Pacific.
Stock markets closed essentially flat today, although the TSX did rise about 46 points. We're still seeing some of the volatility that caused investors fits last week. Darren Farwell is Senior Wealth Advisor of Farwell Wealth Management, and he joins us now with a closer look. How are you?
I'm well, thank you.
So, insane volatility last week, unlike we've ever seen before. Has it subsided, or are you still seeing a fair amount of it?
A little less volatility today. You know, I've heard through the week last week that, well, volatility's back. You know, we've been in the business since 1986. I don't think volatility ever went away. It was certainly a little more extreme last week as we try to find a direction and a solution to some of the problems that are facing North American and global markets.
How much of this volatility is coming from high-frequency trading? How much is fear? I mean, it's difficult to peg and gauge, I guess.
I can't answer your question on high-frequency trading, but it's true that a lot of it's coming from fear. And what's the fear? The fear is double-dip recession in the United States is something you hear a lot of people talking about. A fear that politicians aren't going to be resolved some of those issues that are outstanding in terms of debts, both in North America and in Europe.
Now, for months now, since the Great Recession, we've been hearing that the private sector has to take the baton and run with it, and they are to a degree in terms of earnings and cash on the balance sheet, but they're certainly not hiring. In fact, a lot of them are cutting. So when and if will the private sector start to do that?
Wow, that's question of the day, because as a matter of fact, we've gone through that part of the recovery cycle where the governments are stimulating the economy. They've run out of money. We know that. We can hear it in the headlines every day that they're out of money. So they're not going to be the engine of the economy anymore. So who's got to take it over? It's got to be the private sector, the corporate sector, as you said. They have great balance sheets. They have more cash than they've had in 50 years. Their earnings are coming in at better than expected. So corporations are ready, but they're not willing yet. And why aren't they willing? Because of problems we've talked about. Is there going to be a recession? Are they going to solve the problems we have with debts in the U.S. and in Europe?
And what about some of the government measures that we may see coming? We're hearing today that President Obama is planning a major speech in September on jobs. He may ask for more spending from Congress. Some would say good luck with that, getting that by the Republicans. What do you think?
Well, politics, I can't really predict politics. I mean, Obama certainly needs to come up with something to help his prospects for the next election. When you're in this phase where we're changing leadership from the government to the business sector, you never know what's the thing that's going to be the catalyst. You know something's going to come eventually. It could be his speech in September. We may see more monetary easing from the United States. That may now not help the economy. It didn't last time, but it'll keep rates low. That in itself is some stimulus.
We have a number of guests who think that we are in a bull market. Like I'm thinking of Derek Webb of Webb Asset Management. Despite what happened last week, he says we're in a bull market, and we should embrace that. Do you think that? And back to those catalysts, what will drive markets higher?
Well, I do believe the idea that we're in a bull market if what he's saying is that the recovery phase started back in March of 2009 at the bottom of the market. That's a 3 or 4 year cycle to get through the recovery phase, and as a natural part of that, there's usually a pullback when the government stops stimulating. So we're on track historically where we expect to be. What could the catalyst be? We need companies to start hiring and investing for growth. So we're waiting for that to happen, and we need to get some answers to some of these questions that we have before they're likely to do that.
Now, I understand, Darren, that you raised some cash back in the springtime. Did you put some of that to work in the last 10 days or so?
Yeah, absolutely. Yeah? We raised a little bit of cash in the spring because the models looked like things might be getting a little bit overvalued. We didn't want to be out of the market entirely, so we would raise 15 to 20% in cash. Whenever the market gets down 17%, which it did last week, it's a great time to step up and buy some large cap dividend paying stocks to help produce that income that people need in retirement.
Okay, tell us what you like.
Well, we like large cap dividend paying stocks on a pullback. On a pullback, we certainly like the commodities in Canada because at the end of the day, there is growth in emerging markets, and that growth supports commodities. So we like commodity stocks in Canada on a pullback, and we like stocks like potash because it fits into the theme of the world needs food, and a lot of it, and potash is going to help it get done.
All right, just quickly back to dividend payers. The parent of BNN, BC, I understand you like it. It's got a dividend of what, about 5% or so?
Yeah, it's got a great dividend. So if it's in a non-registered account, you get the dividend tax credit, which pushes up that yield relative to what you're getting in GICs, 2.5%. And it's a well-managed company with what we suspect to be good earnings growth over the next couple of years. So it's a nice combination of growth and dividend.
And there's a look at the stock of the mothership. Now, Trans-Canada Pipeline has been a bit of a laggard, but you like this. Is this a valuation call, or why do you like the trap?
You know what? The U.S. government just came out and said we're going to keep yields low for years to come. Well, if you're going to keep yields low, that means interest rates are going to be low. Dividends look very attractive. So the dividend you get from a company like TransCanada Pipeline really makes up for the fact that it may not have all the growth you'd like, but a great dividend while you wait for some of that to happen.
And do you prefer that over the likes of Enbridge?
Enbridge is a similar type company. So we like them. We like that space overall.
Okay, back to potash. What are your prospects for this company? It's done tremendously well since it rejected BHP. It seemed like it was the right thing to do.
Well, we really, before potash takes off, we really need global growth. I mean, when we start seeing global growth heat up, when we start seeing people buying growth stocks again, you know potash is going to be one of the ones they flock to very quickly. So we like to get into that stock when the prices are still floundering a bit for when it starts to take off.
Okay, switching over to metals, you like Freeport-McMoRan. This is a copper-gold company.
Yeah, and Freeport-McMoRan simply because it's kind of the benchmark. They own two things that we love. They own gold, and they love copper. So they have the commodity, they have the gold, we like that. Furthermore, you get to buy U.S. assets with a good Canadian dollar. So we really like buying Freeport when we see the Canadian dollar at $1.02, $1.04, $1.06. That's when we really like to add to those U.S. positions.
And just lastly, we've got a little less than a minute here. Again, last week, were you rubbing your hands in not so much glee, but you were opportunistic, or were you feeling that fear and panic too?
We were a little optimistic. As I said, we raised cash and we were willing to go and spend just a small portion of it. As I say, when you see some of the bank stocks trading at dividend yields where they were, you nibble away at it. When you see some of those high-quality dividend-paying stocks where they were, you buy some then. We were buying cautiously.
All right, very good. Thank you, Darren.
Thank you.
Thanks for
Nice
coming
to be
in.
here.
Yeah, we'll see you again. That was Darren Farwell of Farwell Wealth Management. For further market analysis, join us tonight on Market Call.